Rob, European stocks, notwithstanding a bit of a dip this week, are up about 15% in the year to date, and we're only in March. That's a fantastic run. What's going on? Is this all Mario Draghi and his fantastic QE?
There are always more explanations for changes in markets than anyone could ever need at any given time. But I think there are kind of three pieces you have to keep in mind here. One of them is kind of technical, one has to do with the currency, and one has to do with fundamentals. On the technical point, European QE is enough to absorb all the new issues of European credit, period. So sovereign, corporate, high yield, low yield. And as a result, investors who might have normally been buying those issues are going to be pushed somewhere. And the betting goes they're being pushed into stocks. Certainly, that's how it seems to have been played out in the United States. There's your technical issue.
But that kind of rally can only last as long as QE does.
Right, exactly. So maybe we put that in a sort of special category of artificial things. Now moving towards more fundamental things, the currency. This is the simplest argument of all. Lower euro, better for European exporters, better for employment, better for consumer sentiment. Virtuous circle starts turning there. Finally, you have the fact that the European economy is actually surprising to the upside. Consumer sentiment is going well. Manufacturing data is kind of mixed, but on the whole, there are green shoots here. So between those three things, a 15% rally, to me, in an index that has been underperforming global indices for a long time, room to run.
But looking ahead to the future, that 15% rise already prices in some of the growth. It prices in those green shoots continuing to appear and then growing on top of that as well.
Right.
Is there really much justification for prices going much further after such a strong start?
Of course, Lex is not in the business of calling short-term market movements. Our position is a fool's errand. However, we do care about valuation, and we do think in terms of long-term returns, over and above these sort of shorter-term factors I've been talking about, over and above the economy, it pays to buy at reasonable valuations. European valuations, though obviously they've come up in this rally, still look pretty reasonable. If you look at prices next to long-term average earnings, the multiple, the equivalent of what they call the Shiller P, the multiple looks pretty good. And the gap between European valuations and US valuations, for example, while it's narrowed some, is still there. So I don't think valuations should scare us away.
Well, in the US, the big concern is when Janet Yellen will take away the punch bowl. In Europe, the punch bowl's just arrived. Rob, thanks very much.
Sure.